Good morning, everybody. Welcome to the morning meeting of the ARMR Investing Way, our virtual hedge fund experience. I'm going to share with you big picture stuff, macro, risk monitor, how we intend to carry positions, what positions we're going to carry into the weekend, depending on the type of close we have today. We'll go over top stocks to watch, a new group that is the highlighted group of stocks, some of which we probably add to the portfolio today, and it's going to be the ARMR dividend portfolio. So we'll go over that. I'll talk to you about how I'm handling some short positions, all of these things. You're the portfolio manager on the desk. Take the information, figure out your risk tolerance, your goals, and be the smart money on your own. You're the smart money. Have confidence in yourself to execute your strategy. That's the path to investing success right there. So diving in, Risk Monitor Red. Risk Monitor has nailed this sell-off. We're in max cash. We've been there for over a week. We're avoiding the selling. The selling's getting a lot worse. Friday's close is going to be, of course, key. A weekly close on the lows and a big red candle probably is the beginning of something a lot more nefarious. But who knows? Market tends to rally on a Friday after a week that's brutal like this. Puts get dumped eventually. People book profits. So there could be some nice day trading rallies today, and you never know how long they last or whether or not they spill over in the next week. The weekly pictures are what I like to look at. So there's no real new update on the risk monitor. It's red. It could always turn green, but the structure right now of all of these indexes is so negative that there's no green signal anywhere in our future. You know, sometimes I say to you, risk monitor's green, but hey, right around the corner, we could get positive. Nothing even close to that. So what I would remind you today is that the biggest 1 to 2 day rallies historically, statistically, happen in bear markets. So you could get huge rally off the lows today, gap up Monday morning. That would actually be indicative of a bear market, not the beginning of a new bull market. So before you see us start putting money back to work on the long side, there's a lot of pieces that would have to fall into place to turn that picture around. Instead, most of those pieces are just getting a lot worse, right? I mean, new lows are blowing away new highs. The breadth is just god awful and, just plummeted yesterday. And then you have weekly charts that look like this. So, the equally weighted S&P is what we're looking at. That's the broadest view of the market. And you can see this is weak. It's breaking down. I mean, it's just real ugly. Now, I mean, the candle's not over. So who knows? Huge rally today. Candle doesn't look so bad. It's possible. It's certainly possible. Let's drill down into there's the daily chart. I mean, it doesn't get more ugly than that. So I started off today's missive for you saying you can't really put any lipstick on this pig. It's a pig. And they may be sweet animals that like to roll around the mud. But when it comes to this euphemism, I mean, it's god awful. All right? I mean, it just looks terrible. It would be no benefit to me coming on here saying, well, this and that could happen, and maybe that could be bullish. It looks awful. Risk Monitor's red. 5.5% risk-free rates on U.S. Treasury bills we're collecting. Who wants to take risk? And that's what happens to the market. So the biggest issue, and I'll just roll through a couple of the charts, right? So here's, the big cap tech stocks that have been holding up the market are imploding. There's no way, unless, again, you would have to get some unreal rally today to make this week not look god awful. Here's the week equally weighted NASDAQ is just a disaster. Small cap stocks are plummeting. Remember, we talked about this earlier in the week, this head and shoulders pattern on small caps. Well, here it is. They're making a short trip down to here, and this is why I'm short the small caps. TWM is the asset I'm using to be short the small cap. So this is a win no matter what. If it keeps going up, I'm going to make money. This is twice the negative performance of small caps, right? It's twice the performance. So small caps drop 1%. This thing's up 2%. I've raised my stop to the low of the gap up day. So comes back down, I'll book a profit and get out of the short. But if it accelerates from here, you can see the potential of that pattern breaking out. It's pretty ugly for the market. And that's just the inverse of this, which is the head and shoulders breaking down. And what's driving? Well, before we get there, let's just look at the Dow real quick. The Dow is breaking down, looks awful. This was a very bullish pennant that's just rolled over and broken the uptrend. So, this is a problem. It's a real problem. The innovative stocks have already taken out the lows of last year. The innovative stocks taken out the lows. ARK is only up here because it's got a piece of Tesla in it, but Tesla's breaking down now. Right up to the top of its channel and failed. Right there, that possible breakout failed. Looks terrible. Go look at the big cap 7 that have been holding the market up. NVIDIA's breaking down, which means semiconductors look god-awful. Apple has already been leading the breakdown. Microsoft looks terrible. Amazon was holding the market up a little bit. It just cratered. Google with it. Google just cratered. Meta's right at the 50-day, holding up better than most. So as we go through those charts, you can see how awful it is. There's no way to pretend it's anything different than awful. So I'm short for all. These are aggressive portfolios only, aggressively traded portfolios. So if you're listening to the morning call and you're not with me on the desk all day, you've got to be careful because I could be out of these shorts in an hour. I don't stay with shorts very long. I move my stops down as it goes down. I'm just trying to make a little extra coin. The majority of my capital is sitting in U.S. Treasury bills at 5.5%. Risk-free. So I'm just having a little bit of fun, honestly, on the short side. And if it gets to be not fun, I'm out. Okay. XHB, I've just been stalking this for so long, and I'm on it here. We shorted it up in here. It's gapping down yesterday, and this is the double top that we're on. So, that's to me the most important short. I don't see how the home builders don't implode. So short home builders, and I have a piece of KRE short. I don't know what to do with this position, but I'm short KRE. I suspect that the regional banks are going back down to the lows. And so now I bring you to the highlighted research of the day. And that is the canary in the coal mine. You've heard me say this before. It's always true. And that's high yield debt. And what's been really kind of a head scratcher in the last 12 months is that rates keep going up and it doesn't affect high yield debt at all. The high yield debt market holds up and credit spreads keep getting tighter. So why is that important to you and me? If high yield debt holds up, and we can follow this through the ETF HYG or JNK, junk bonds is what we're talking about. If that most sensitive part of the debt market, which has always been the canary in the coal mine when it comes to the left tail collapse, right? If it holds up, it takes the left tail collapse out of the bell curve. So when we're looking at the equity market and we're watching the market sell off, risk monitor's red, market's going down. It's an orderly sell off right now. There's nothing wrong with it. When market's down like what, 5.5%, 6% off the high. Not a big deal. It's really not a big deal. So as an investor, we would want to be working on our whiteboard, getting ready for the next risk monitor green, whenever that is. Happy to put capital to work. That's what we're looking for. Okay. Happy to put capital to work when algos tell us to. What we are concerned about is the tail risk. Something breaks in the system and the market craters. And the canary in that coal mine's always been junk bonds. All right, so HYG is the ETF I'm looking at. And this pattern is just, This is becoming disturbing. This is a massive wedge. So during the last 12 months, high yield debt has actually been in an uptrend, telling you there's no tail risk and credit spreads have been tightening. This week, yesterday, was the breakdown in high yield debt. Now, just to put in perspective why this consolidation is so head scratching to me, the pandemic lows for treasury yields were basically 0.04% for 1 year, all the way up to 0.99% for the 30-year. And now, and by the way, that was all the way from 2020 to 2021. So we had rates between the 1 year was 0.04, the 2 year 0.09, the 5 year 0.19, the 10 year 0.52, the 30 year 0.99. When you can only get less than 1% on a 30-year bond, the stock market's going through the roof because there's nowhere else to get yield. There's nowhere else to get performance. So people are plowing money into equities. Fast forward to today, the 1 year yield is 5.46%, up from 0.04. The 2 year yield is 5.14. We're inverted. The 5 year is 4.61. The 10 year is 4.47. 30 year is 4.55. But that's up from 0.99. How is it possible that high yield debt hasn't broken down? It's hard to understand it. And so what I'm concerned about is an immediate dislocation in junk bonds. Is this the beginning this week? I don't know. It's had sell-offs and then immediate rallies throughout this entire pennant. But is this the beginning of the decline? If it is, then what you have to do, and there's a lot of lines on that screen. I'm not sure that's going to help us, but this is the weekly pattern I wanted to look at. So it's a weekly breakdown. Certainly it's attacking these lows, right? So what we have to be concerned about as equity investors, I mean, we're already max cash, so it's not about us. But if you're looking for, if you're not max cash, if you're a longer, you envision yourself a longer term investment, you have more and wider stops, you're continuing to put money to work even though the market's going down. You would want to stop all of that behavior if junk bonds crater. Okay, that's what I'm telling you, because if junk bonds crater, tail risk shows up. That's really been off the table all year. Tail risk is, lack of a better way to say it, like a crash, like the market just craters. And when the market just craters, everything goes down with it. I'm going to share with you 3 stocks I want to put in my dividend portfolio today. I may do it. And I'll use stop losses, right? Because if I do it here and then junk bonds implode, I'm going to get stopped out of those positions I had today. I guarantee you that. I don't care how good they look. Everything in the market will come down at once if junk bonds crater and tail risk is back on the market. Okay? So keep your eye on junk bonds. The problem yesterday is that junk bond spreads rose 11 basis points. It's not a shocking amount, but it is a change in trend. Spreads have been tightening throughout the year. So for them to start widening, and you look at HYG breaking down and you look at the market cratering yesterday, this is a concern that you've got to keep your eye on. Okay? So pay attention to that. Now, 2 things we were doing yesterday, one on the research front and one on the portfolio. All right? So we're building a position in precious metals. An asset that can perform well when tail risk shows up is precious metals. I was pleasantly surprised by the behavior of gold and silver yesterday. I expected gold and silver to get wrecked with the market. The dollar was up a little bit. What did the dollar do yesterday? Yep, the dollar is near the highs of the dollar is near the highs of the week and the highs since July in like a straight line. And what's amazing is that gold is actually making higher lows since July. You would expect gold to be making lower lows with the dollar in an advance that's that aggressive. So what we did yesterday, on the weakness in the morning, okay? This is the intraday chart of spot physical gold. So we added to gold yesterday, right here, okay? Closed right around where we added it, maybe a little bit below. Looking to open up 1% this morning. Spot physical's up 1% this morning, around 1510. That's going to be up here. That's going to be up here. It's going to gap back up this morning. So if it closes the week back above the 50-day moving average and can close the week near the highs of the week with the dollar at the highs of the week, that's telling us something very serious. I don't know about tail risk, but certainly about precious metals. Silver was even stronger. We picked off silver right off of the bottom yesterday, and it ripped to the close, and it's up over 1% this morning. This is going to trade around 804, making a new high for the week. So if gold and silver, I mean, gap ups in the metals, I never buy. So let's be clear on that, right? We bought gap downs yesterday. So we had our initial position size on, gap down. We bought it using day trading tools, making money now as they gap up this morning. I have a small piece left. What do I have? I have about a quarter of the position left to put on. So if we have a weekly close that's strong, I'll finish off my physical position. I have 3/4 of the position on. I'll put on the last quarter of physical gold and silver, and I will initiate a position in Nugget, which is 2 times GDX. This time I'm not going to run around buying a bunch of different metal stocks. If somebody wants the metal stocks, then I would suggest, as always, the royalty plays, Wheaton, Franco-Nevada. Okay, but I don't have any interest in these charts. I don't want to do these. I'm not, and OR is the other one, Royal Gold and OR, okay? What I'm looking at is GDX. That's the pattern I want. I think it's very difficult and dangerous to choose a mining stock right now. We don't know the political environment. We don't know, even a royalty play might have too much of a royalty in some South American country that decides to repatriate the metal. Who knows? I can't deal with that risk. But if the price of the metal goes dramatically higher, the group as a whole will go up. And so I'm going to go after the ETF. And if I want to be more aggressive, then I'm going to buy twice the ETF. And then I really challenge anybody out there to find an individual stock that's going to double the performance of GDX. They're not going to be many. You know, if you're going to do it, you probably want to dig in the dirt, literally, in a small cap name, a micro cap name. If I want to take risk, I may as well take risk in like a micro cap, small cap mining company in Nevada or something, right? Because at least it's in the US and maybe they have a huge amount of reserves. And if the metal goes berserk, maybe that stock's going to outperform GDX by a factor of more than 2. But all the other big names that are international miners, forget it. Just give me double the GDX and I'm done. So I only execute that if we're strong into the close. As you can see, GDX, and I'm just going to blow it up for you, it gapped down yesterday, right? And so unless GDX can recapture, and see this green box here, I don't really want to add mining stocks unless we get a weekly close in that green box. So if we get a strong close today, I might add a quarter to a third of a position. And next week, if it pops into the green box, I'll start jacking up my exposure. And then to round out our discussion, 3 stocks into the dividend portfolio. ARS has done it again. ARS, you've been pounding the table, doing the work, doing the footwork, doing the research on the shipping stocks. There's 3 energy shipping stocks that I'm looking to put in my dividend portfolio today. Okay, there's just no way to avoid it. It starts with PRMD. And we were talking about this yesterday into the close. The weekly chart here is just phenomenal on this stock. The yield is enormous, 21%. They pay $1.50 a quarter, or $6 a year. There's the higher low. So here's the initial move up, the pullback. This is the buy trigger week. Right now, the MACD is starting to separate, and the ARMR algo on a weekly level is given the risk on entry point. So if there's ever a time to own the shippers, of course, they're going to gap up 2% today. So, I'm going to have to pay up for them, I guess. But that's okay. We see this thing close up at the top of its range on a weekly level. I'll get long TRMD with a low of this week as the stop. I'll get long EURN. We've already done the research on this. I love this idea. There's a perfect double bottom. We did research here, and it got crushed. So it was not time to own the stock. Now it's time to own the stock on a double bottom move. And if you look at the weekly chart, there's the perfect double bottom setup. I'm willing to put that risk on in my dividend portfolio with a low of this week as the stop. And then FRO is the last that I'll own. These are the 3 names that I'll put in the portfolio, all with the biggest dividends, all with the right type of cup and handle formations. Research has been done by ARS repeatedly throughout this whole period. They popped up, they pulled back, they found support at a higher level. The weekly close is strong. I'll put a position on there. Those are my thoughts for you today. I look forward to working with all of you on the desk at 9:30. And at the end of the day, you've got to be your own risk manager. So be the smart money. Take all these thoughts under advisement, and then figure out your risk tolerance, your goals, and execute accordingly. I'll see you guys on the desk shortly.